Okay, so someone hands you a casino. Not a poker table in your basement, the real thing. A gleaming resort on the strip, chandeliers the size of small cars, a casino floor that never closes, never sees daylight, and never really goes quiet. Thousands of people walking in every single day, sitting down at your tables, feeding your machines, and handing you their money one bet at a time. The house always wins. That's the whole business model, right? You just sit back and let the math do the work. It is not that simple. Owning a casino is one of the strangest businesses in the world, because the house winning on any individual bet has almost nothing to do with whether the casino itself is profitable. There are casino resorts that generate hundreds of millions of dollars a year in pure profit. And there are casinos that opened with over $2 billion of construction debt and filed for bankruptcy within 2 years of their grand opening, despite the house edge working exactly as designed on every single table. The difference between those two outcomes is not luck, and it is not the odds. It is a business built on razor-thin structural margins wrapped around one of the most heavily taxed, most heavily regulated industries in America. Before we go further, we need to be clear about what a casino actually is, because the word covers several very different businesses. A Las Vegas Strip mega-resort is really a hotel and entertainment company that happens to have a casino floor attached, and in most of these properties today, gaming revenue is no longer even the majority of what the building earns. A tribal casino operates under a completely different legal and tax structure, run by a sovereign Native American nation under a compact with the state, and often exempt from certain state and federal taxes that a commercial casino has to pay. A riverboat or regional casino, common across the Midwest and South, is usually a smaller, standalone gaming hall with none of the resort amenities, competing purely on convenience and slot machine volume. And an online or mobile sportsbook operation, the fastest growing category in the industry today, has almost none of the physical overhead of the other three, but faces a different kind of regulatory and marketing cost battle entirely. This script focuses primarily on the commercial land-based resort casino, the model most people picture, and the one with the most moving financial parts. Let's talk about what it actually costs to build one. A large-scale Las Vegas resort casino today runs somewhere between $2 and $5 billion to construct, and that number has climbed steadily over the past 2 decades as properties compete on scale and spectacle. Resorts World Las Vegas, which opened in 2021, cost roughly $4.3 billion to build. The Cosmopolitan, a smaller property by comparison, cost close to $4 billion when its full construction and delays were accounted for. These aren't casino budgets in the traditional sense. Roughly 70 to 80% of that spending typically goes toward the hotel towers, restaurants, retail space, theaters, and convention facilities. The casino floor itself, the part everyone pictures when they hear the word casino, is often a relatively small fraction of the total square footage and total construction cost of a modern resort. You are not really building a casino. You are building a small city with a casino floor sitting at the center of it, because the casino floor alone can no longer reliably fund a project of this size. Before you open the doors, you also need a gaming license, and this is where the regulatory cost of the industry becomes clear. In Nevada, a non-restricted gaming license application alone can run into hundreds of thousands of dollars just in application and investigation fees, on top of a background check process that can take a year or more and examines the finances, criminal history, and business relationships of every major investor involved in the project. States treat casino licensing as one of the most scrutinized approval processes in commercial real estate, because a gaming license is effectively a license to legally take money from the public in a structured, regulated way, and states are protective of who they hand that privilege to. Miss a disclosure, have an undisclosed business partner with a questionable history, and the entire license application can collapse after years of work and tens of millions of dollars already spent on the project. Say you've cleared licensing and construction is complete. Now comes the equipment, and this is a cost category most people never think about at all. A single slot machine costs somewhere between $15,000 and $25,000, and a large resort casino floor might carry 2,000 to 3,000 machines. That's tens of millions of dollars in slot machines alone, before a single coin drops. Table games require felted tables, custom chip sets, shuffling machines, and increasingly, sophisticated electronic tracking systems that monitor betting patterns in real time. Then there's surveillance. A modern casino runs thousands of cameras covering every square foot of the gaming floor, cash cage, and back-of-house cash handling areas, feeding into a dedicated surveillance control room staffed around the clock, because state gaming regulations require an auditable, recorded trail of virtually everything that happens on the floor. This isn't optional security theater. It's a mandatory compliance system, and building it out across a large property can run into the tens of millions of dollars on its own. Now let's talk about what it costs to keep the doors open every single day, because a casino resort has one of the highest labor intensities of any hospitality business in existence. A large strip resort can employ anywhere from 5,000 to 12,000 people, covering dealers, pit bosses, surveillance staff, hotel housekeeping, food and beverage, entertainment production, valet, and security. Payroll alone on a property that size can run into the hundreds of millions of dollars annually. Then there's what the industry calls comps, complimentary rooms, meals, and entertainment given to players, especially high-value ones, to keep them on the property and playing. A casino's marketing budget is built almost entirely around the economics of comping, because a free hotel room that costs the casino $60 in incremental expense might keep a player on the floor for an extra 6 hours, generating far more than $60 in expected losses across that time. Get that math wrong, comp too generously to players who don't play enough to justify it, and comps quietly become one of the largest uncontrolled cost leaks in the entire business. Gaming taxes are the other major recurring cost, and they vary enormously by jurisdiction. Nevada taxes gaming revenue at a relatively low rate, historically around 6.75% at the top tier, which is part of why Nevada became the dominant gaming market in the country in the first place. Pennsylvania, by contrast, taxes slot machine revenue at over 50%, one of the highest rates in the nation. A casino operator evaluating a new market has to run this tax rate directly into their entire financial model, because a 50% tax on slot revenue changes the entire viability of a project in a way that a 7% tax simply doesn't. This is why casino companies lobby so aggressively in every state considering gaming expansion. The tax rate written into that legislation will determine whether the business is enormously profitable or barely breaks even for the next 20 years. Here's where the actual revenue engine gets interesting, because it works completely differently than most people assume. The house edge on any individual game, meaning the built-in statistical advantage the casino holds, is usually small. Blackjack might run somewhere around 0.5% to 2% house edge depending on the rules and how well the player plays. Slot machines typically hold somewhere between 5 and 15% of what's wagered over time, varying by machine and jurisdiction. That means for every $100 run through a slot machine over its lifetime, the casino statistically keeps somewhere between $5 and $15. This sounds modest, but the entire business model depends on volume and repetition. It's not about winning big on any single bet. It's about a house edge grinding against millions of individual wagers, hour after hour, night after night, where the law of large numbers turns a small percentage into a highly predictable, stable revenue stream over time, as long as enough volume flows through the building consistently. But here's the trap in that math. Individual sessions, especially with high-value players, can swing widely against the house in the short term. A single high roller placing enormous bets over a weekend can win millions of dollars from a casino in a single visit, purely due to short-term variance, even though the house edge mathematically favors the casino in the long run. Casinos manage this risk the same way an insurance company manages catastrophic risk, through a combination of betting limits, close relationship management with major players, and increasingly, through reinsurance-style financial arrangements where large potential losses from a single big win get spread or hedged. A casino's quarterly earnings can genuinely swing based on whether a handful of the highest-stakes players happen to get lucky that quarter, which is why publicly traded casino companies specifically call out unusually high or low table game hold percentages in their earnings reports as a source of volatility that has nothing to do with how well the underlying business is actually being run. And here's something that surprises people even more. At most modern strip resorts, gaming is no longer the majority of total revenue. Hotel rooms, food and beverage, entertainment, nightlife, retail, and convention business now frequently generate more total revenue than the casino floor itself at the largest properties. This shift happened gradually over the past 2 decades as Las Vegas repositioned itself from a pure gambling destination into a broader entertainment and hospitality destination. The casino floor still matters enormously, both as a direct profit center and as the reason a huge number of guests choose that specific resort over a competitor down the street, but the idea that a casino resort survives purely on gambling losses is increasingly outdated for the largest properties, even as it remains completely accurate for smaller regional and tribal casinos that don't have the scale to build out those other revenue streams. Let's build the 2 honest scenarios. In a good year, a well-located, well-managed resort casino runs at healthy occupancy, table game hold percentages land in the normal expected range, comp spending stays disciplined relative to player value, and non-gaming revenue from hotel and entertainment grows alongside it. A property generating, say, $1.2 billion in total annual revenue might see operating margins in the 20 to 30% range once payroll, comps, gaming taxes, and overhead are accounted for, translating into $250 to $350 million of annual operating profit. That's the version of this business that made companies like MGM Resorts, Caesars Entertainment, and Wynn Resorts into some of the largest hospitality companies in the country. In a bad year, occupancy softens because of a broader economic downturn. A handful of high rollers get unusually lucky and the table games hold percentage comes in well below normal for a quarter. Comp spending creeps upward as properties compete aggressively for the same shrinking pool of high-value players, and debt service on the original construction cost, often financed with significant leverage, continues regardless of how the floor performs that quarter. Margins can compress dramatically, and because these are extremely high fixed cost buildings, with enormous payroll, utility, and debt obligations that don't meaningfully shrink just because fewer people walked through the door, a moderate revenue decline can turn into a severe profit collapse very quickly. The clearest real-world example of this whole business going wrong despite the fundamentals working exactly as designed is Revel Casino Hotel in Atlantic City. Revel opened in 2012 after a construction cost of roughly $2.4 billion, making it one of the most expensive casino resorts ever built outside of Las Vegas at the time. It was designed to be a non-smoking, high-end destination resort that would single-handedly reposition Atlantic City as a premium market again. Instead, it struggled from its very first month. Atlantic City's overall gaming market was already shrinking due to competition from newly legalized casinos in neighboring Pennsylvania and New York, pulling regional gamblers away before they ever needed to make the drive to the Jersey Shore. Revel's massive debt load, taken on to fund that $2.4 billion construction cost, required a level of consistent revenue the property could never actually generate in a shrinking regional market. The casino filed for bankruptcy within roughly a year of opening, filed again a second time within another year, and ultimately closed permanently in September 2014, just over 2 years after its grand opening. The building was eventually sold for approximately $82 million, a staggering 97% write-down from its original construction cost. The house edge worked perfectly on every table inside Revel for its entire operating life. The casino simply never generated enough total volume, across a market that was actively shrinking, to service the debt used to build it. Now here's the twist that explains why sophisticated investors keep pouring money into an industry with examples like Revel sitting right there as a warning. Over the past decade, much of the casino industry has quietly restructured itself around a strategy borrowed directly from the shopping mall and retail real estate world, separating the real estate from the operating business. Companies like VC Properties and Gaming and Leisure Properties operate as real estate investment trusts that own the physical casino buildings and land, then lease those properties back to operating companies like Caesars or MGM under long-term, triple-net leases, meaning the operator is responsible for essentially all property expenses while paying the REIT a contractual fixed rent regardless of how the casino floor performs that quarter. This structure allows the real estate owner to collect stable, bond-like rental income almost completely insulated from gaming volatility, while the operating company, the one actually running the tables and dealing with variance in high-roller sessions, carries the operational risk. It's the exact same structural logic that saved shopping mall ownership from total collapse: separate the volatile, hands-on business from the stable underlying real estate, and let two very different types of investors each own the risk profile they are actually equipped to handle. For Native American tribal casinos, the twist is different but equally important. Because these operations are run by sovereign tribal nations under gaming compacts with their state, revenue that would otherwise be heavily taxed at the state and sometimes federal level is instead used to directly fund tribal government services, healthcare, education, and per capita payments to tribal members, an entirely different value proposition than a strip resort chasing quarterly earnings for public shareholders. Same slot machines, same blackjack tables, same fundamental house edge math, but a completely different reason for existing and a completely different definition of what counts as a successful year. What separates the casinos that build empires from the casinos that end up like Revel is almost never the games themselves. The house edge works exactly as advertised in both outcomes. What actually determines the winner is whether the building was financed with debt the market could realistically support, whether the property found a genuine, defensible reason for guests to choose it over every other option in a hyper-competitive market, and whether the ownership structure spread risk intelligently instead of betting an entire multi-billion-dollar construction budget on gaming volume alone. The house always wins on the felt. Whether the building around that felt survives long enough to collect on it is an entirely different bet.